this will be a better year than last year for the stock market. Will it?
For sure, it will be better. And actually, I tweeted on it recently that the rabbit will help you more than the tiger did. And it is very simple because if you look at the big picture issues affecting the world last year, one was the US market and the US interest rates, and one was maybe China and its policies and everything else that they might have done wrong. Both have gone past their negativity in some sense, and I think both the markets will be flat to up. China is actually already up a lot. And therefore, two external influences which were negative last year, which I think hurt India, are not there. So then we have to create our own negatives, and hopefully we will not create that in this budget by having some capital gains or something. So it should be okay.
You think it's coming? Because
No,
this time the noise is louder than last time.
No, actually, I don't think it is louder. I think the strategy is that if you don't have it, then we will all call it a good budget.
That's true. Yeah, they fly a kite before the budget. Yeah. But you don't think that 1 to can become 3 years?
It is such a waste of an opportunity to do that when, first of all, the world, nowhere in the world do foreign investors pay tax anywhere. Like even Indian was to buy stocks in US, there is no tax in US except for tax on dividend if you buy them in Singapore, Hong Kong, etc., etc. So you make it even tougher for an FII to justify. But the second thing is, we keep saying every day that our GST collections are up, our railway revenue is up, everything is good. Why do we need one more avenue right now to collect extra resources? I don't think it is needed, and I don't think they are doing it.
Okay. Talking about this year, when we started the year, almost everybody seemed to be saying that the first half will be tough, but the second half will be good. Do you agree with that, or is it too much of a consensus for the market?
There's too much preciseness which is not needed. Look at it big picture. In the US, the US market has been negative 2 years in a row, very rarely. In the last 25, 27 years, only once. In 2000 and 2001. Supposedly in the last 100 years, it is negative only 4 times. That 2 consecutive years were negative. So if we look at last year, what was the issue of FII selling, which was in the first half something like $28 billion. It had to be for non-India reasons, because I don't think India did anything specifically bad in the first 6 months last year for us to have a 28 billion outflow. Because in general, foreigners invest. In India, they have only sold net in a calendar year 4 times in the last 20 odd years. And all of our bad years, 2008, 2011, 2018, you could say was India related maybe a little bit, and last year. So one reason would be US interest rates, US inflation, and that is out of the way. And plus minus 2-3 months, the US interest rates would have reached the current target, which is say 5 and 5.25 type. One will be on Feb 1. So in 2-3 months that would be over. The China problem is over. Actually the sad thing has been, which I never imagined, that to get to their rebalance in China, it seems that they are actually taking out money from India, because the flows right now are positive in all of China, Taiwan, Korea, all markets except India. I think that is a little bit of a rebalance which I never imagined. But I don't think that rebalance that you take out of India to fund other markets, that I don't think is a very longer term thing. So if both those markets are okay, then our external thing is positive to flat, and then we can move on in life.
But sometimes people sell something because it has done well. Do you think that could be India's problem?
I don't agree with that, because last year in absolute the Indian market was flat. So what happened was that China did very badly. Now China did very badly not for random reasons that you don't precisely know. It's like saying 2 companies are going up, and then suddenly after some time you realize that, oh my God, one company's valuation relative to other has gone up a lot, and therefore there will be a mean reversion. But if the second company has fallen because of very specific, some corporate governance issue, some very poor result kind of reason, then you can't say no, they should move in the same band. I think China issues were specifically hurting investors, and all of that cannot be forgotten just because now you'll play a mean reversion. But in the first round, it is happening like that people are playing the rebound. Plus minus a few months, the big new allocators are unlikely to put the same amount in China as they might have been doing before in proportion and as a percentage, as if whatever was happened in China was just a 1 year story. So I think it'll be okay in a few weeks plus minus.
If this is going to be a better year than the previous year, is it your expectation that we'll have double-digit returns? Because last year was flattish.
Yeah. So do big picture. So in every 6-7 years there's one bad year.
Yeah.
That one bad year is not bad only for that year. It takes away the returns of the previous year and mostly sometimes even the 1 year before that.
3 years.
So you get 4 years of returns in a 7-year cycle. So that means the years in which it is positive on average is more than the 13-14% 7-year average. So when it is up, it has to be up more. Now that part you might be right that might happen in the second half. Why? Because the US will be keeping these rates for some time. They say 8-9 months, whatever. So maybe by end of year the US rates will be cut, which also allows India to cut and all that. And if the world is actually relishing a rally, then all that will happen by end of the year, because a few months will be at these high rates which are not increasing anymore but are still quite high, the US rates. And therefore I think end of the year you might in one spurt get the last 5-7 extra percent to have your overall returns higher than 10% for sure, I think.
So the gains will come in the last quarter?
I'm saying if for the general year the market is flat to up a little and then you get something right at the end, that also is acceptable. All we don't like is a minus 10% kind of a year. Plus, we all accept that over time equity markets beat debt by a reasonable number, which is like 5 to 7% per annum, which is basically the equity risk premium, which means what the equity markets deliver relative to government 10-year type bond of that same market, that globally and in India on annualized basis is 5, 6, 7% per annum. So that normally leads us to be 13, 15, 14% type of return, which you can see we have done for the last 25 years, for the last 10 years, for the last 18 years. Why I say 18 years? Because Helios started 18 years ago, so I know exactly what the index has done. Broadly speaking, it is the 13, 15%. So plus minus a little bit, it'll do the similar amount.